While most investors are chasing the next hot stock, hoping for a 10% gain, there's a group of savvy investors who are collecting thousands of dollars in passive income every single quarter, like clockwork. We're talking about yields that pay you 5%, 6%, even 7% or more annually, deposited directly into your account whether the market goes up, down, or sideways. In a world where traditional savings accounts are paying less than 1%, these 7 dividend powerhouses are handing out serious cash to their shareholders. But here's the catch. Not all high-yield dividends are created equal. Some are traps that will devastate your portfolio, while others are genuine wealth-building machines. Today, I'm breaking down 7 dividend stocks that are not only paying over 5% in 2026, but actually have the financial strength to keep those checks coming. Let's dive in. Number 1, Altria Group, MO. First up is Altria Group, ticker symbol MO, currently yielding around 7.5%. Now, I know what you're thinking. Tobacco? In 2026? Hear me out. While smoking rates continue to decline in the United States, Altria has been a dividend aristocrat for decades, and they've been aggressively pivoting their business model. The company owns Marlboro, which still commands nearly 43% of the U.S. cigarette market share. But more importantly, they've invested heavily in smoke-free alternatives, including their Enjoy e-cigarette brand and their stake in Juul, which they've been managing carefully. They also hold a significant position in Anheuser-Busch InBev and a cannabis company, Cronos Group, showing they understand the need to diversify. What makes Altria compelling for dividend investors is their incredible free cash flow generation. Even with declining cigarette volumes, their pricing power allows them to maintain margins and fund that massive dividend. They've raised their dividend for over 50 consecutive years. The risk? Regulatory pressures and continued volume declines. But for investors seeking reliable income with a historically stable payout, Altria deserves consideration. Number 2, Enbridge, ENB. Next, let's talk infrastructure. Enbridge, trading under ticker ENB, is a Canadian energy giant yielding approximately 6.8%. This company operates the largest oil pipeline network in North America, transporting roughly 30% of the crude oil produced on the continent and nearly 20% of the natural gas consumed in the U.S. Here's why Enbridge is special. Their business model is built on long-term contracts with built-in inflation protection. About 98% of their cash flow comes from cost of service or take-or-pay contracts, meaning they get paid regardless of commodity prices. It's like owning a toll road for energy. The company has increased its dividend for 29 consecutive years, even through multiple oil crashes and economic downturns. They're also transitioning toward renewable energy, with significant investments in offshore wind and solar projects. In 2026, they're positioned to benefit from increased natural gas demand for power generation, especially as data centers and AI infrastructure expand. The dividend is sustainable with a payout ratio around 60 to 65% of distributable cash flow. For investors who want exposure to energy infrastructure without the commodity price volatility, Enbridge is a fortress. Number 3, Verizon Communications. VZ. Telecom is often overlooked, but Verizon, ticker VZ, is offering a yield near 6.4% and represents essential infrastructure in our digital world. Every streaming service, video call, and cloud application runs through networks like Verizon's. Verizon has invested over $150 billion in network infrastructure over the past decade, and they now have the most extensive 5G network in America. While their stock price has been relatively flat, allowing that yield to climb, the business fundamentals remain solid. Wireless service is non-discretionary in 2026. People will cut cable, skip vacations, even reduce grocery spending before they cancel their phone service. The company generates massive free cash flow, around $18 to $20 billion annually, which more than covers their dividend payments and debt obligations. They've been reducing debt levels, improving their balance sheet, and focusing on high-value customers rather than chasing market share at any cost. Yes, competition is fierce with T-Mobile and AT&T, and capital expenditure requirements are substantial. But Verizon's network quality, customer loyalty, and cash generation make this dividend one of the safer high yielders in the market. Number 4. Realty Income Corporation, Realty Income, appropriately nicknamed the monthly dividend company and trading under ticker O, yields around 5.3%. What sets this real estate investment trust apart is exactly what the nickname suggests. They pay dividends monthly, not quarterly. Realty Income owns over 13,000 commercial properties across the US and Europe, leased to approximately 1,400 different tenants. Their portfolio includes recession-resistant businesses like dollar stores, drug stores, convenience stores, and warehouse facilities. These aren't luxury retailers that vanish during downturns. These are essential businesses. Their leases are typically 10 to 15 years with built-in rent escalations, creating predictable, growing cash flow. The company has increased its dividend for 29 consecutive years and has made over 650 consecutive monthly dividend payments. That's consistency you can bank on, literally. In 2026, Realty Income has been expanding into Europe and into new property types like data centers and industrial facilities, diversifying beyond retail. Their occupancy rate remains strong above 98%, and their investment-grade credit rating gives them access to cheap capital for acquisitions. For investors who want regular, reliable income with built-in growth, Realty Income delivers. Number 5. Pfizer, PFE, healthcare giant. Pfizer, ticker PFE, is currently yielding approximately 6.2%. After the post-pandemic adjustment, where their COVID vaccine revenues normalized, the stock price has pulled back, pushing the yield to attractive levels for income investors. Pfizer's dividend is backed by a diverse pharmaceutical portfolio, including blockbusters like Eliquis for blood clots, Ibrance for breast cancer, and Prevnar for pneumonia prevention. They've been incredibly active in acquisitions, purchasing Seagen for $43 billion to bolster their oncology pipeline, which represents the future growth engine. The company has paid dividends since 1980 and has increased them for the past 14 consecutive years. With an aging global population and increased healthcare spending worldwide, Pfizer is positioned to benefit from long-term demographic trends. The pharmaceutical industry does face risks: patent cliffs, drug pricing pressure, regulatory challenges, and the constant need for innovation. However, Pfizer's scale, pipeline depth, and proven ability to develop breakthrough treatments make them a relatively safe bet in the healthcare sector. The dividend payout ratio sits around 40 to 45%, leaving room for future increases even as they invest in R&D. Number 6, Iron Mountain, IRM. Here's one you might not expect. Iron Mountain, ticker IRM, yielding around 5.6%. This REIT specializes in information management services, including physical record storage, data centers, and asset lifecycle management. You might think physical storage is dying in the digital age, but Iron Mountain has brilliantly pivoted. Yes, they still store millions of boxes of documents for corporations, hospitals, and governments who have legal requirements to maintain physical records. But they have also become a major player in data center development, which is exploding due to cloud computing, artificial intelligence, and digital transformation. Their business model is incredibly sticky. Once you're storing sensitive information with Iron Mountain, switching providers is complex, expensive, and risky. This creates high customer retention rates above 95%. They have over 225,000 customers across 60-plus countries, including 95% of the Fortune 1000. The company has raised dividends for 11 consecutive years and generates stable, recurring revenue through long-term contracts. As data creation accelerates exponentially and regulatory compliance requirements increase, Iron Mountain sits at the intersection of two powerful trends. For dividend investors seeking a unique, defensive position with growth potential, this is worth investigating. Number 7, British American Tobacco, BTI. Rounding out our list is British American Tobacco, ticker BTI, with a massive yield hovering around 8.5%. This UK-based tobacco giant owns brands like Camel, Pall Mall, Dunhill, and Lucky Strike, with operations in over 180 countries. The ultra-high yield reflects investor concerns about declining smoking rates and regulatory pressures globally. However, BAT has been aggressively building their new categories business, including vaping products like Views, modern oral nicotine products, and heated tobacco. These segments are growing rapidly and now represent over 18% of their revenue. What makes BAT attractive, despite the obvious headwinds? Pricing power and geographic diversification. While volumes decline 3 to 4% annually, they raise prices 6 to 8%, maintaining revenue and margin stability. Their exposure to emerging markets in Asia, Africa, and Latin America provides growth opportunities that don't exist in mature Western markets. The dividend has been maintained through various crises, supported by strong free cash flow generation. The payout ratio is higher than ideal at around 70%, but still sustainable given their cash generation. This is definitely the highest risk stock on our list. But for investors with strong risk tolerance seeking maximum current income, BTI delivers the highest yield. There you have it, 7 dividend stocks paying over 5% in 2026, each with unique characteristics, risk profiles, and opportunities. Remember, high yield alone doesn't make a good investment. You need to evaluate dividend sustainability, business fundamentals, competitive positioning, and your personal risk tolerance. If you found this breakdown valuable, smash that like button and subscribe to the channel so you never miss our dividend analysis and income investing strategies.